Hey everybody, welcome to the morning market briefing 6/9/22. Hope you're doing well out there. Big day, lots to talk about. Market not really moving. Dow futures up 5 bips, S&P up 3, NASDAQ up 7. Let's start with notes from the Ecb meeting. Tom, what are we hearing?
Yeah, so bits and pieces coming in as they meet. I think the meeting kicked off at 7:45. The big news, big headlines is the first piece is that they're going to end the PEP, which is the Pandemic Emergency Purchase Program. And that's program with 2 M's and an E, if you're keeping track.
The Programme.
They're going to end that on July 1st. So they're accelerating their quantitative tightening a little bit. Additionally, they're going to keep a little bit of flexibility there. They're basically saying, hey, we're going to stop buying bonds, but we might also start buying Greek bonds because Greece is the redheaded stepchild of the ECB and the European Union has been for, as long as I can remember. Greek bonds blowing up was a big situation back in like 2012, 2013. So they're going to have to continue to help Greece because Greece is just a dying economy and has been for quite some time. Additionally, they're going to raise interest rates. They're going to do one hike in July, and that's going to bring them to a whopping negative 25 basis points on their target rate. So they're going to have to raise again in September just to get to zero. So it's not going to be, massive waves in the bond market right away, but once they start hiking in earnest, it could affect us as well. And it may actually be a situation where we may not have to hike so drastically because our rates will go up in sympathy with the European Union. So we'll see how that affects us. I think that, September seems to be a big fulcrum point for the Fed. They have their Jackson Hole meeting. There's been a lot of talk about potentially a pause there, and that might be potentially some fallout from them talking to ECB, who may be also getting aggressive in terms of the quantitative tightening. Other information coming out is that they have updated a lot of the inflation and growth numbers for the next couple of years, and a lot of that is to the downside. So, for example, CPI for 22, 23, 24, they've got it at 6.8 for this year, 3.5 for next year, and 2.1 for 2024, and that's up from 5.1, 2.1, and 1.9. And then growth has been guided down. The initial growth estimates they had for this year were 3.7, 2.8 for next year, and then 1.6 for 2024. And it looks like they're pushing some of that growth out. So they're estimating for 2.8 for 2022, 2.1 for next year, and 2.1 again for 2024. So a slight uptick in 24, but a slight downtick in 22 and 23. So they're basically saying, hey, we're going to slow growth here. We're not going to go to zero, but we're going to kind of have a glide path. But I still think that 2.8 for this year, is almost mathematically impossible. I think at this point, we're halfway through the year. They have yet to print a positive number, I think. And
especially when you have interest rates only 2 hikes away from being positive.
Yeah, exactly. So not a lot of optimism coming out of Europe. They're just, they're perpetually behind. They're perpetually stuck in their weird bureaucratic quagmire. And I think, again, we always talk about this, but Brexit seems to have been a positive move for the UK, even though they're having their own struggles, but at least they can, drive their own car. Yeah, they're not attached to the mothership anymore.
That was a good breakdown. There was Europe. What would you say? I guess this is not on the script, but Ben, I've been in this industry for 11 years. You've been in it relatively similar amount of time. Tom, you as well. How, as long as I've worked, it's been like, invest in Europe, need more European exposure. How do you gel that with the fact that, we're joking about it and obviously it's a known fact, but interest rates are negative. How do you reconcile that?
Well, the stocks always look cheap. And the reason they look cheap is because there's not much growth. So you can buy a bank like Credit Suisse for a lot less money than you can JP Morgan. Why can you buy Credit Suisse for a lot less money? Well, because Credit Suisse has guided down 3 times already this year, and it's going to lose money this year.
They lose, and they also are very prone to rogue trader blow-ups. Societe Generale, Credit Suisse, Barclays, every single one of them has a situation once a year where it's like, we had this one guy who accidentally lost us $300 billion because he didn't know how he was going to trade something.
After 2008, they never recapitalized the banking system in Europe. So you had Deutsche Bank, you had the American banks. Everyone was 40-1 leverage, which means you had 2.5% equity for all your assets. That sounds like a lot. Today we're at 10 or 11, 12%. That, again, that sounds like a lot, but it's certainly a lot better than it was, 4 times more capital. But the European banks have never been recapitalized. The European industrial companies, it's tough to really earn a huge profit when you're giving people 60 days of vacation a year.
Yeah.
And you're also selling into economy which has a shrinking population and debt issues. And I think that ultimately is the issue. We've never solved the debt issues in Europe. We've never solved the population issues in Europe. It is structurally a slower grower than the United States. And that's why the stocks trade cheap. And that's why people want to invest in it, because the stocks trade cheap, but all stocks are not created equal.
Yeah, you don't get a lot of quality goods at the dollar store.
That's a great point. I think people get kind of enamored by the whole, good things happen to cheap stocks thing. I think there's some truth to that on a relative basis. If we were looking at 10 American companies that substantially do the same thing, and one trades far cheaper than the others, there may be an investment thesis buried in there. Like Europe as a whole trades cheap. That's probably for a reason. When you see entire sectors of the S&P really get banged up and, valuations come down, it's usually for a reason. We did get initial jobless claims, came in at 229,000. Expectation was for 206,000. I don't know. I'm not surprised by the number, or either of you guys.
I'm not surprised, but that's something that we're going to have to watch closely, because if we start seeing tick ups like this is exactly what I was thinking might happen. And this is exactly what it would look like. So, in a normal economy, 229 is just random noise versus 200 estimate. But in this economy, we're looking for a little bit more of a continued uptick. We did bottom in the 100s at one point. 200 would seem like a little bit more of a homing beacon. But if we maybe 229, then maybe 215, and then 240, and then 260, that's what a slowing economy looks like. And that's when you start to see the unemployment rate tick up.
Pretty weak 10-year auction yesterday. Ben, I know you gave it a C-. Santelli gave it a D- just moments later. Probably didn't want you to front run him, so he went down. We do have a 30-year auction today. Tom, what are you kind of keeping an eye on?
I just don't think demand's going to be strong today. Heading into CPI, I think you're looking at the longest possible duration on a treasury you can lock into at a new issue, with CPI coming in 12 hours later. I mean, if it's a really bad number, that 30-year is going to get crushed. And if you lose, for every basis point you lose on a 30-year, you're losing a significant amount of money on your principal. And so I think that there's going to be very weak demand. I think that the 3-year was a good indicator that people are somewhat willing to take some short bond exposure. The 10-year yesterday went off pretty softly. And we saw a drop in indirects, meaning foreign investment came down, which I think also is a real glaring sign that people are not really excited to jump in on that level of duration. And so you triple up the interest rate risk by going out to 30 years and add on top of that CPI coming on tomorrow. I think demand is going to be very weak, because, you can avoid stepping on a landmine by not stepping on it. You know what I mean? If you see it on the ground, you can't be like, well, we got CPI tomorrow, I'm going to step on it anyway. Maybe I won't blow up. You don't have to buy it. Nobody has to buy these bonds. And so as a result, I think a lot of people aren't going to do it unless they absolutely have to, and they're going to wait to see the next one.
2 things. First is the roll off is going to impact the shorter end more than the long end, because the Federal Reserve has bought more treasuries 10 years and in than the 30 years. So the quantitative tightening isn't going to affect the 30 years much. The second thing is, it seems to me like the amount of pension funds and insurance companies that bid in the auction yesterday, international was very weak, and that's a majority of the demand. But there was a lot of pension funds and other domestic players who are buying. And I'm wondering if they're going to continue to buy in the 30-year. And because you're not having the runoff from the Fed like you did for the 10-year, I wonder if it could be a little bit better. But I'm generally in the ballpark of you, Tom. I don't think the demand is really gonna win anything. If anything, it's probably just kind of a relief. Man, at least we didn't bomb out on the 30-year like we did the 10.
Yeah, I mean, today is not a day to be buying bonds aggressively. It just isn't. I mean, unless something is extraordinarily cheap today, and I really need a bond for a specific account and that lines up, I'm probably going to be extremely picky, because if things don't go the way that we want to tomorrow on CPI, I mean, you could really get popped in a really short period of time. And
Yeah,
so I
and
think
right after that, having Fed commentary that
Yeah, and a
that
hike.
may very well overcorrect as well.
Yeah, and then you've got a double hike. So the short end's at risk, the long end has natural risk. It's just this is a tough week, to be a buyer of bonds if you absolutely have to. But on the flip side, if it goes the other way, you could do very well. But we already have plenty of bonds on the books, and those bonds will do well. So
Why don't we just switch to inflation now?
Yeah, I was going to say it does sound like Tom just kind of declared on air that he's taking the day off, but we'll kind of skip over that. CPI coming tomorrow. The expectation for the headline number is a 0.7% increase month over month, 8.2% year over year. Ex food and energy looking at a number just shy of 6% year over year, 5.9. Does anybody at this table, let's start here and then we'll get to some of the Biden commentary, because I think it's very important that we know he met with Jimmy Kimmel. Does anyone here expect that we're going to see a very positive surprise that indicates inflation is really slowed down?
I just don't know what the catalyst would be. I mean, there's no real indicator that used car prices are coming down. There's no real indicator that healthcare prices are coming down, or that gasoline prices are coming down, or that home prices are coming down in the function of how they measure them in CPI. Even though raw housing prices may be coming down, the measure they use is absurd. And so probably won't be a good indicator unless, they manipulate that number in some way, which they have every, capability of doing to make sure that we come in under. But my expectation is it's going to be in line or over slightly, but I just don't see it being 7% instead of 8.2. I think it's either going to be right in line or it's going to be slightly above.
Yeah, go ahead, Ben.
I would say, I mean, just to take the other side of the argument, my base case is more in line with Tom, but on the other side of the argument, I would say two things. Number one is Sam Frost, who works here, he has a mathematical model that has it coming down a little bit more significantly to 7.7 to like 8.1 is kind of his range, which would be good news. And that's just objective math. It doesn't really take into account the story so much. But I think that there is some reason to think that sometimes just being objective about things might help. But also, I mean, even these merchandise markdowns that we've seen, that's coming into effect now. It's not going to be impacted by the CPA report from May.
I mean, I have a really hard time thinking we're not going to see a print in the 6% range on the ex food and energy basis. I mean, we had the question
versus the 5.9 estimate.
Yeah. I mean, that one, absolutely. I feel like it's going to be high. I mean, I think we could see a headline number that is in line. I think best case is headline numbers at 8.2. And they say, hey, we're slightly improved versus where we were. We told you it peaked. But under the surface, when you take out food and energy, I think you're going to be higher.
The rate hike expectations have gone up. They're now at 11.5, which is up from like 10-ish just a couple of weeks ago. I mean, I think that we're going to have to be between 12 and 14 before we can actually say the Fed is actually trying to get on the front end of this. I'm kind of in the minority on that opinion, but I continue to think that that's the case, and we're getting closer there. But the Fed is going to have to change things a little bit.
Biden says that inflation is the bane of his existence. Ben, you had some editorial commentary. What do you say? Kind of, what's your takeaway? I mean, it just seems, again, this isn't a political statement. I think if either side of the aisle were making these comments, it seems unbelievably tone deaf.
Yeah, so I tried to transcribe it as best I could, but I mean, it was tough. So if you want the actual thing, just go on YouTube and watch it. But it's as accurate as I could do it. He said, inflation is the bane of our existence, mostly in food and gasoline. But if you look at all the costs a family has on a monthly basis, it also includes healthcare, prescription drugs, childcare. I'm proposing that we reduce the cost of these things. So, I mean, that's great. That's great. He also goes on to say we're the fastest growing economy in the world. Unemployment is down to 3.6%, reducing the deficit. My view is we're objectively not the fastest growing economy in the world. We declined 1.5% in Q1. Europe, it didn't grow much, but I mean, it was 0.6%. they're not going to hit the numbers, as we said. They're not going to hit the 2.8 for this year, but they're growing faster than us, unbelievably, at least into Q1. Atlanta Fed has us growing at 0.9% in Q2. That's continued to come down. They were in the twos just a few weeks ago. I continue to think that may go negative. So, but even if you say that, concede the point that we have the best house in a bad neighborhood, is it really good to say that we have a recession, but we should be happy that it's not as bad as the next guys? And then the other thing is, he says, quote, "I'm proposing we reduce the cost of these things." One is, he's not proposing that we reduce the cost of food. He's not proposing that we reduce the cost of shelter.
Yeah.
He's not proposing we reduce the cost of gasoline. He's talking healthcare, prescription drugs, childcare, whatever it is. He's trying to do price controls. And I think that that's also dangerous. And we need to figure out a supply-oriented solution for this problem. That's the sustainable solution. The other solution is just, it's frankly, classic economics is economic loss as a result of these price controls. So I don't think it's a great strategy. And we need a better strategy. Bottom line is, we need a better strategy on this front, on the fiscal side, and we need a more aggressive strategy on the Fed in order to really kick inflation. Maybe the Fed backs out. Maybe the fiscal policy backs out, but in order to kick inflation, we need two good strategies, and we're getting none of them right now.
Yeah, and I think on a political side, from a schematics, tactical, what have you, we've seen a lot more. I feel like from him really leaning kind of employment forward, really pushing. Look at employment. Look at employment. Look at employment. We've been saying really for the last month or so, those initial jobless claims are important again, keeping an eye on those. And we talked about those tons, obviously, in early 2020 or mid 2020. I don't think the employment picture is as rosy as it was 2 months ago, 3 months ago, 4 months ago. At some point, from a messaging standpoint, that's either, if that remains his lead counter to the inflation argument, one of two things is going to happen. We're going to see employment struggle, and that's going to come back and bite him in the rear end. Or, as we've talked about some in our investment committee, I would not be surprised to see the Fed say that is our priority. We have a dual mandate, but we're going to really make sure we're keeping employment in check and let off the gas a little bit with these rate hikes, which is not what I want, but I think that's on the table.
I mean, I think that's what's happening. But the thing is, it's a double-edged sword. You're either going to fight inflation, or you're going to keep people fully employed. The downside of fighting inflation is people are going to lose their jobs as a function of interest rate policy. And so, Biden's met with Powell over the last couple of weeks, and he's met with Janet Yellen, and the line seems to be drawn that we are going to try and at least get through some election cycle and say, hey, we're putting jobs in everybody's pocket, everything, we're doing an awesome job. But the downside of that is anyone who has a job can't afford to buy anything. And I think that's, from an economic standpoint, and from what everything the Fed has said historically, Jay Powell and others, is that if you don't have price stability, it doesn't really matter what employment is. And so that's the sacrificial lamb. You need to attack it. You need to attack the employment market with raising rates, and that will bring down inflation. But I think we're going the opposite way, which is, I think is going to be net negative. I think we've got terrible leadership, not from even a political standpoint, but just from what are we doing? I propose we lower the cost of beer. Okay, well, what is that? Yeah, great proposal. How do we do it? There's none of that. There's zero of I propose we lower the cost of childcare. Okay, great. It's you know what I mean? That's not a plan. There's not a plan here. What we're saying is, man, we need to, if inflation is the bane of its existence, unfortunately, that you got to attack it, and that's going to hurt the jobs market. But that's the opposite of what they're actually doing.
And the thing that drives me nuts is how much they talk about prescription drug costs. I mean, that is a universally accepted positive political talking point for both sides of the aisle. Trump talked about it. Biden's talking about it. It never happens. It never gets done. And even if it did, this isn't your idea. It's everyone's.
Yeah,
this isn't leadership.
Hey, we gave Pfizer $50 billion, no strings attached. make them lower the prices, make them do it. They just got a bunch of money for you for free in government contracts that we all paid for and continue to pay for. Make them lower the drugs. Hey man, I scratched your back. Now you scratch mine, but that's not what's happening.
No. Switching gears a little bit, two quick hitters. Facebook changing their ticker to Meta. They changed the name last year. This is just a simple change, not split, like we talked about with Amazon. And Intel warning that things have deteriorated. But not necessarily a ton to say here. I mean, I think it's relatively consistent with what we've seen, but it is interesting to see maybe the breadth of companies saying this.
Yeah, two things on the Facebook thing, just for your accounts. Note that we didn't just buy this random company called Meta. It's just change of name from Facebook. But that'll be in the accounts reflected today. Second, on the Intel side, basically they're saying there were 3 issues last time when they came out and talked. They said that there's a slowdown in demand because customers couldn't get enough components to build the product. They said that customers are reducing inventory levels, and then there's the Shanghai closure. And they said, quote, in all 3 cases, the circumstances at this point are much worse than what we had anticipated a month and a half ago. Again, not a surprise. We've seen this from a lot of other companies, but Intel was down almost 6% yesterday as a result. The thing for me is Intel is just poorly run right now, because if you're going to come out and say this and say that things are much worse than what you had anticipated, you're basically guiding down for the quarter. So just guide down for the quarter. Don't just say things are really bad. We don't really know what's going on. Demand is bad. Demand is continuing to get worse. Actually come out and be upfront with that. Intel is definitely losing market share. So that's another factor to watch. But overall, PCs are weak. Smartphones are weak. Those are facts. And we continue to try to avoid those where we can.
Awesome. We'll wrap it up there. Sorry we went a little long today, but tomorrow will probably be longer. We got CPI coming through. So it should be a hot one. Hope you guys have a great day, and we'll talk to you